Welcome everybody to another screencast. Our topic today, causes of the Great Depression. We're going to see people having to live in shacks, and look at this from the Chamber of Commerce. Jobless men keep going. We can't take care of our own. And it's going to leave a lot of men, very proud men, to stand in bread lines to try and get any food, and also unemployment lines to try and find a job. Our learning outcomes for today, you should be able to understand how diminished demand affected farmers and businesses in the 1920s, describe the effect that falling income had on consumer behavior, describe the causes of the stock market crash and the beginning of the Great Depression, and lastly, discuss how the Great Depression affected the worldwide economy. So industry struggles. Railroad, textile mills, and steel mills are barely turning a profit. Railroads are facing competition, not just for people now, but also for freight. They're having competition from buses, and now with these very primitive 18-wheelers. Wartime industries are down. Of course they are. There's no more war. It's taken a few years for us to feel the effects of this, but mining is going to be down, and the production of lumber is going to be down. Mining is going to face heavy competition, especially coal mining. Hydroelectric power, fuel oil, and natural gas are now very viable alternatives to coal power, and it's also cleaner. And the key economic indicator is a decline in new housing and other related industries. Think about everything that goes into a house, from the lumber to the roofing materials to the windows, the doors, drywall inside, and that's just a few of those things. You can probably count 30, 40, 50 different businesses that have to do with building homes, and when those go down, it really affects everything. So farmers' troubles. World War I, international demand is way up, of course, because Europe is not producing their own crops, which forces prices up, simple supply and demand. So our farmers are going to plant more. And to harvest the crops faster, they're going to take out loans on their farms for farming equipment. After World War I, prices are going to drop. So these farmers are no longer going to have the money in order to pay these new loans. And their income as a whole in the United States is going to drop $6 billion in 2 years during the 1920s, a very significant number. They're going to be unable to pay their loans, which is going to lead the banks to foreclose on these farms. The problem with the bank foreclosures is they have to auction it. If the farmers fail, the banks are going to fail, and with these auctions, they're really going to get less money for these farms than market value. And again, if the farmers fail, if the auctions don't bring in enough money, the banks are going to go under as well. So the big question is, can Congress help? So Congress can help. Sure they can. The problem, how they're going to help is price support, the McNary-Houghton bill. This was going to allow the government to buy these crops at higher prices, wheat, corn, and tobacco, for example, and then they would sell them on the world market, and buying them at a higher price, which is going to subsidize these farmers. Calvin Coolidge is going to veto the bill not one time but two times. He doesn't believe that farmers have ever made money and that government intervention will not help them in any sort of way. So us consumers, we're buying less by the end of the 1920s. Prices are going up, wages are staying where they're at, and debts are going up. That enjoy today, pay later is starting to catch up with us. We are living on credit. This is what we do here in the 1920s. This is what a lot of Americans are still doing today. The problem with this is when we face a large amount of debt, what we should do is cut back. And this is what a lot of Americans did in the 20s, and now these businesses are all going to feel the effects of it. A lot of these people are only buying one new outfit per year. By the 1920s also, we have a growing wage gap. The rich are getting richer, the poor are making less. The top 1%, their income is going to go up 75%. For everybody else, it's only about 9 or 10%. 70% of Americans are going to earn less than $2,500 a year, which is the poverty level. So 7 out of 10 are below the poverty line. Okay, that's pretty significant to note. Also, only half of the homes in a lot of cities have electric lights or furnaces. This is 40 plus years after Edison invented electricity and the light bulb. Okay, so this is going to be a big problem with the wage gap that's going to start to develop here. Also, about 1 in 10 homes are going to have refrigerators here by the end of the 1920s. So the stock market, what a lot of people think causes the depression. No, it doesn't. The stock market is the most visible symbol of American prosperity. Okay, Wall Street, the numbers going up and down. We see all that ringing of the opening bell. The Dow Jones Industrial Average is the barometer of the stock market's health. This tells us how well the United States is doing, supposedly. Okay, the Dow itself is not the entire stock market. The Dow is a measure of 30 large publicly traded firms, and we'll see a few of those here in a second. By the mid-1920s, the Dow is going to reach 381 points. Now, when I say this is not real, a lot of this is being bought on credit, just as if you were to go to a department store and buy $100 worth of merchandise on a credit card. Until you take that $100 out of your wallet and pay that credit card company off, that's not real money to you just yet. Okay? Americans are going to rush to buy stocks in this bull market where 4 million people are owning stocks at this point. They want to get in on the action. They see the market going up and up and up. They want to be rich. They don't want to be left out. So they buy on a margin because they don't have enough money to buy all the stocks they want by themselves. So they buy on credit. And they're speculating for a quick profit, a huge profit. The problem is what happens if it crashes, and this is what is going to happen. So, a few of the companies that are on the Dow: Microsoft, Disney, AT&T, McDonald's, Coca-Cola, Nike, Home Depot, Cisco, Chevron, Verizon, IBM, and GE. These are, again, just a few of them. Very large, very notable companies. Now, the crash itself. October 24th, investors are going to sell stocks, and the market is going to plunge. Now, throughout September and early October, these investors are wavering. Some are buying, some are selling, some are selling, some are buying, and the market's kind of up and down, up and down, up and down. 5 days later, October 29th is going to be known as Black Tuesday. The bottom is going to fall out of the market. $16 billion in stock is going to be dumped. That's about $160 billion in today's money. Okay, millions of stocks are not going to be able to find buyers. So companies are virtually going to go out of business when all their stock gets sold. With those people that bought on credit, buying on that margin, now that $100 worth of stock that they bought, 75 of it on credit, now maybe it's only worth $5 or $10. So now they have a huge amount of debt to pay back. $75 is not an easy make in the 1920s. That's a lot of money. You can kind of see here, 1928, when Hoover takes over, we have this permanent plateau of prosperity, he says. And it goes up. Our market's going up. We think, hey, he's right. Up until 1929, and we see this drop. And it drops, and it's not even the worst part yet. By the tail end of Hoover's presidency, we see a little bit of recovery, and then the bottom's going to fall out. By 1932, it's at the lowest that it's been, close to 40 points. And once FDR takes over, we start to see a little bit of recovery with the New Deal programs. So the financial collapse itself, it is important to note the stock market crash marks the beginning of the Depression, but it does not cause the Depression. Okay? The ripple effect is what causes the Depression. There's $30 billion lost by mid-November, the same amount of money that we spent on World War I. People are rushing to the banks to withdraw their money. Problem with this, though, once the bank had no more money left, that was it. They closed up shop. You may not have got your money. Some people save 30 or 40 years to go to the bank to be told, sorry, we don't have any money, because the banks had also invested in the stock market and lost everything. By 1933, 44% of banks have failed. The gross national product was cut in half, down to $59 billion, and 90,000 businesses went bankrupt. The worst part of all, 25% unemployment rate by 1933. Right now we have a 7-8% unemployment rate, but now, 1933, 13 million workers are out of a job. People get relegated to living in their cars, moving out west, especially after the Dust Bowl. Guys are out on the sides of streets advertising themselves. You can see wanted, decent job, 37, family man, veteran, age 44, and the other guy wanting a decent job. These guys don't want to go to the unemployment line. You see children out. Why can't you give my dad a job? And a lot of people are going to be forced to live in what is going to be known as a Hooverville, where they have makeshift shacks put up and basically made out of anything that they can find, like this picture here. Now, worldwide problems, it's not just the United States. Europe is also suffering. They're still dealing with the issues from World War I, trying to get the Germans to pay their war reparations, which is a task in itself. 1930, the United States has a brilliant idea to pass the Hawley-Smoot Tariff Act. And what this is going to do is be a very, very high protective tariff, the highest one that we've ever had in our history. It's designed to protect business from foreign competition, but it actually does the opposite. It makes things worse because foreign countries are going to raise their own protective tariffs. Thus, we will not be able to send our goods overseas, and foreign countries will not want to send their goods to the United States. So unemployment is going to be made worse. Now those companies that were dealing in shipping and receiving are now also going to go belly up. Ultimately, by the end of this, world trade is going to drop 40%. It's going to be a significant hit to worldwide trade. Now, the common causes: falling consumer demand, tariffs and war debt policies creating no foreign markets for goods, farm crisis, them losing $6 billion, credit being way, way too easy to get, and the rich getting richer and poor getting poorer, this unequal distribution of wealth. And ultimately, the big-time culprit of this whole thing is the government interest rates. These interest rates are going to be kept so low which is going to allow easy debt buildup for a lot of Americans who cannot manage their money properly. So a recap, how did diminished demand affect farmers and businesses in the 1920s? How did falling income affect consumer behavior? What factors led to the beginning of the Depression aside from that market crash? And lastly, what impact did the Great Depression have on the worldwide economy? So these questions you should be able to answer after watching this screencast. So if you have any questions, let me know. Thank you for watching, and we will see you next time. I'm out.